The futures market is already pricing in a 25 basis point cut, 75% chance over here, and 80 something on FedWatch tool. So if you just thought you just wanted to bet with the FedWatch tool, which is generally accurate, right? Whatever is more than 80%, more than 85% on the FedWatch tool is generally what's going to happen. Just betting for that, you'll make 30%, 33%. All right.
How do you make that trade on the market if you don't want to do Poly or Kalshi?
Sure, you could absolutely make it on the market. You could be shorting bonds. You could be doing a bunch of things. The thing is that if you do it in the futures market, that's already priced in at 86%. So you're not making any premium on that. But if you use a betting market, then you would make a premium on it. Jeff Snyder from Eurodollar University, my go-to plumber for the Eurodollar system, the global financial system. Let's see what he has to say. We're going to take a look at just the first part of this. You guys can always go to his channel at Eurodollar University and watch the full video. Definitely worthwhile.
Yeah, the Federal Reserve is going to cut by 50 basis points at its next meeting in September. As I told you about at the end of last week with Steve, in the wake of the shocking jobs report for the Fed, watch this week. You're going to see Fed policymakers come out and start talking about how dovish they were. And that's just what we're getting. I mean, there was already 2 dissenters at its last meeting last month anyway. Plus, in treasuries and as well as money market options, money is pouring in on not only just rate cut expectations for September, it is really pouring in on a 50. There were already a number of softer indications that not everyone at the FOMC was happy to just sit there and wait and wait and wait for tariff inflation that was based on really bad theory, putting up zero evidence. In fact, as I keep pointing out, price measures like the CPI and especially the PPI haven't just been devoid of inflation evidence. They've actually gone over to the weak side of the economy quite emphatically.
All right, so those are 2 things that matter quite a bit here. That we've had dissenters within the voting members and non-voting members of the Fed that are dovish, which means they want to cut, right? Now, the whole thing with the with these voting members is that it is it's a show, right? They're doing that for us. It's forward guidance. They're not really fine. They might be arguing amongst themselves, but if there's really a disagreement that they don't want us to know about, they won't let us know about it. So if we do know about it, that's them signaling to us that, hey, in the future, when we make this change, it won't just come out of nowhere. See, we've been saying this the whole time, right? So the centers are there. And so then you also have, because they're seeing the same data we all are. Right? They're seeing that the reason why they've been keeping the interest rates high is because they were worried about tariff inflation, right? They were worried about tariff inflation, that the Trump tariffs would cause prices to go up, and that would flow through the consumer in the same way that the supply chain shock of 2021, 2022 caused inflation to peak. So they didn't want to be on the other side of that. They certainly didn't want to be cutting while that happened. There's no tariff inflation. There seems to be no tariff inflation whatsoever, and no one can really point to it. And consumers are not complaining about it. It's not flowing through. We're not getting that in anecdotal evidence, and we're not even getting the Fed or anyone saying, "Well, yes, this is what we're seeing." In fact, the inflation rate appears to be negative. We talked about this last Friday.
0.3
by 0.3%. And so the Fed should be cutting. All right. So the second part to that, I was making the case that the Fed would cut 50 basis points because they have been doing that. They've been cutting and raising it by 50 basis points. So that would be the new normal. It's sort of like quantitative easing. They're not like, okay, we're going to do a few $1 million of quantitative easing. No, they're going to do billions of dollars because they've been doing billions of dollars. And you can't put the genie back in the bottle. It's always more later or exactly what it was before. Okay. If they are behind the curve and they're late again, then they would again leap forward with 50 basis points and go, hey, we got to cut drastically because we're seeing signs and we want to get ahead. So I can't really see a scenario in which they cut 25 basis points unless they're like forced to do it and it's just for show sort of thing. That to me seems like what would be the case. Now, when we take a look at the the FedWatch tool to see what is the expectation of the market of what will happen, we're seeing that for September 17th, the September 17th meeting, there's a 89% probability that the Fed cuts by 25 basis points. All right. So the futures market, which is like the bet-in market, but for people with real money, the futures market is pricing in one rate cut, 25 basis points. So we're not even in the pause territory, which is 10% chance. We're not even in that pause territory. There's a consensus. There's a consensus that we're going to be cutting. So then it's just a short leap and a hop to think that we might cut by 50 basis points, right? So far, does that seem credible at all, Peter? That hey, we could indeed, if the market is already pricing in a cut, it's less of a hop to think that they'll cut by 50 basis points.
Well, yeah, but I mean, yes, if the Fed isn't political, like I'm not 100% convinced this isn't on purpose to hurt Trump. Now, look, this is conspiracy alley over here, conspiracy corner over here. I don't know, like I don't know anything about this, but I don't understand. You told me, hey, Peter, they're always late.
Yes.
When they come back after being late, do they always do the right thing?
Yes.
And the right thing here would be to cut by 50 basis points. So if they were to cut by 25, you would call that what?
That would be for show.
Political.
Yes. First, just to answer your thing, I don't see any reason why the Fed would want to hurt the president. Why would the boss of the president care about hurting their underling? It doesn't make any sense. It's Federal Reserve, administrative branch, executive branch, House, judiciary, House. This is how this goes. So
Wait,
I don't see why they need to hurt him.
It goes
Sorry?
how again?
No, I'm
What's the
joking.
hierarchy?
It's supposed to be they're supposed to be all equal, and the Fed actually works. But I'm saying the central banks are top, then the president, then the rest of us. And so I see no reason why they're not like equals fighting out. The Fed just has to wait around until the president changes. Like it doesn't make any. I don't see why that matters to them. Plus, what do they gain by that? Jerome Powell hurts the president. What? Like he cares? I can imagine he cares who the president is.
Well, it's to hurt who comes next. A bad economy leads to people wanting to change leadership, change from the Republican Party to the Democrat. I mean, I don't know.
What do they care?
I don't know.
I don't see any reason why they would care. All of the Fed chairmen I've seen, all the board members seem to be like nonpartisan in that sense. I see nothing that indicates that they would ever go so far as to hurt the economy just to make that point. So I don't see that happening. And so what I think they want is just to appear independent. That's the political part. They want to appear independent, so they don't want to do the thing that the president's been calling for them to do. That's it. But at some point, they'll have to.
Chet is asking, what outcomes are y'all discussing?
Right. So the idea here is that the futures market is already pricing in a 25 basis point cut, 75% chance over here, and 80 something on FedWatch tool. So if you just thought you just wanted to bet with the FedWatch tool, which is generally accurate, right? Whatever is more than 80%, more than 85% on the FedWatch tool is generally what's going to happen. Just betting for that, you'll make 30%, 33%. All right.
How do you make that trade on the market if you don't want to do Poly or Kalshi?
Sure, you could absolutely make it on the market. You could be shorting bonds. You could be doing a bunch of things. The thing is that if you do it in the futures market, that's already priced in at 86%. So you're not making any premium on that. But if you use a bet-in market, then you would make a premium on it.
Not financial advice. Do your own research.
Absolutely. Now, the question here is 7% chance of a 50 basis point cut reasonable? Or should this be 20% chance, 50% chance? If that's the case, even before we get to September 17th, as the rhetoric builds up and people think, hey, maybe there's a higher percentage chance that we do get a 50 basis point cut, then this will go up and you can make money on this even before the trade happens. All right. Now, aside from poly market, which I always love. I love placing the bets on the poly market. It's a great idea if you want to, or any event-based site. It could be the event-based stuff on Interactive Brokers. It could be Kalshi. I just use poly market as a blanket term for these event-based markets because it allows you to not have to worry about trading options on currency futures in order to get the trade in. It's a little bit easier to understand. But gold has been going up dramatically, right?
Just before you jump into gold, the chat here. First of all, hi, Aventura. Hello to Emmanuel. Thank you to everybody who's watching. Like and subscribe if you like this type of content. We had a question in the chat. Okay. Emmanuel asked, I'm wondering if y'all are twins. Yes, we are. I don't know if we're fraternal or identical. That's usually the next question. Don't know. But more importantly, what tickers are y'all watching? So, Tom, you're just talking about gold. I wonder if if you have any tickers in mind for what we're discussing here and what we're about to discuss.
So personally, I'm not an individual tickers guy other than Bitcoin. I prefer asset classes. I prefer indices because then you get, you don't have to worry about idiosyncratic risk, right? So the people who bought before AMD over NVIDIA for the play on chips for AI, one won, one lost, right? Compared to the other one. But if you buy the index for that, if you buy a basket, then you gain the benefit of both moving up. And so I much prefer expressing my bets in ES, in NASDAQ, in gold futures, oil, Bitcoin, and US dollar, or shorting or long the euro dollar pair. That's what I normally prefer to do. Because over here, so for gold, and there's usually two ways I'll go about it. I'll either trade the gold futures, or I'll trade options on gold futures. I do prefer options on gold futures because for the same type of move, you can get 10 to 100 times more payout if you're right, but then you also have to be right in the timing, right? As opposed to holding the futures contract because you don't know how long it'll be. So that's normally how I would express my bet. But for individual tickers, I find that a little bit harder, a little bit more unpleasant to deal with.
How do most people feel about it? Like, do most people trade tickers, or is it like what you talked about, index?
Oh, there's all kinds. It depends if you're a short-term, medium-term, long-term trader. It depends how much capital you have, how much time you have. I'm like trading it, right? So I'll purchase something and I'm expecting maybe to hold that for a 2-week move, a 1-week move, where someone else might just be like, well, what do I buy for the next 4 years? Like, I don't want to have to think about it. Right. So it'd be hard for me to say, go ahead and buy gold for the next 4 years, but it's easier for me to say, buy gold for the next 6 months. So it really depends on what your risk tolerance is, how much capital you have, and how long you want to hold the position. All right.
Gold.
So, yes, for gold. So I just want to mention here that generally speaking, when the Fed cuts rates, historically, when the Fed cuts rates, markets drop initially because that is usually they're responding to something bad. Usually some event occurs, some financial event or some company collapses or whatever it is that causes this drop, or geopolitical risk causes the drop. And so they come in on the white horse to shine a light on a white horse in order to cut rates. So that would be an opportunity in order to buy into anything that you think will go up during recessionary period, rate cutting cycle, or what have you. So gold does this. Gold will dip, not always, but usually will dip pretty suddenly along with equities as the dollar goes up in the crisis moment. And that's where I like getting in for whatever trade I'm going to be doing. That's where I would be buying gold for the upside.